The S&P 500 moved 0.06% today. Oil moved 5%. Semiconductors moved 3% the other way. And the whole session traded on a little over half of normal volume.
So the index did nothing, and almost everything underneath it did something. That is the shape of the day, and we will take it apart.
But the thing we most want to talk about today was not in the tape at all. Over the past several days, Google restructured the organization that builds Gemini. Its chief scientist of 27 years left. So did the man who led Gemini.
And the way we read that is a change in what kind of company Google is choosing to be. Research first or execution first? That is our reading. We will show you what it rests on, and you may weigh it differently.
We will get to it after the tape. Let's start with the day.
Quick note, this is education and entertainment, not investment advice. Companies are examples. Never buy or sell calls. Do your own research.
The S&P 500 closed at 7,753.11, down 0.06%. Friday's record close still stands. The Nasdaq Composite finished at 26,605.36, down 0.32%, and the Dow at 53,975.98, down 0.1%.
The Russell 2000 closed at 3,017.40, down 0.56%. The Philadelphia Semiconductor Index closed at 11,993.86, down 2.94%, and that is after it rose more than 9% last week. The VIX was 1545, up 3.69%, which is still low in absolute terms.
The day's real move was in crude. WTI closed at $82.20, up 5.14%. Brent at $87.77, up 5.05%. The 10-year Treasury was 4.7%, about 4 basis points higher.
On gold, we are quoting the ETF rather than the futures contract because gold futures rolled contracts today, and a naive reading of the front month overstates the move. GLD closed at $402.62, up 1.04%. So call it up about 1%.
Here is the fact we think matters most today. The rally that produced Friday's record close stopped being confirmed by participation on August the 4th.
Take the up days first. On July the 30th, SPY rose 1.68% on 122% of its 50-day average volume, and QQQ rose 3.3% on 147%. On August the 3rd, SPY rose 1.42% on 110%. On August the 4th, SPY rose 1.8% on 127%. QQQ 3.4% on 132%.
Every one of those is a large up day on above average volume. Real buyers showing up in size.
Then it stops. August the 5th, 82%. August the 6th, 70%. And Friday the 7th, the record close, SPY rose 0.61% on 80% of average volume, and the Nasdaq rose 1.17% on 68%. That is the thinnest participation of any up day in the run.
And today was thinner still. SPY traded 58% of its 50-day average. QQQ traded 54%.
So the record was set on the lightest volume of the advance, and the 4 sessions since August the 4th have all come in between 54 and 82%. The marginal buyer stopped showing up a week ago.
We want to be careful here, because this is the kind of observation that gets overread.
It is not a sell signal. It does not predict a decline. Markets drift higher on light volume all the time, and plenty of records have been set on thin tape and then extended.
What it says is narrower. The last leg to the record was drift rather than demand, and a thin market is a market with less depth, which means when the next surprise arrives, the move it produces is larger than it would otherwise be.
It tells you about the size of the next gap, not its direction.
There is one more piece, and we will attribute it as reported, rather than something we can verify ourselves. The S&P call-to-put ratio is described as sitting at a 4-year bullish extreme, around 0.9. If that is right, then heavy call positioning sits on top of thin participation. And that combination is what makes reversals violent, because the hedging flow has to unwind through a market with no depth on the other side. The sector tape makes the same point in a different way. Energy rose 4.68% on 112% of its 20-day average volume. Utilities fell 1.1% on 118%.
Those were the only two sectors all day with above-average participation. Financials rose 0.36% on 77% of normal. Healthcare rose 1.67% on 66%. The S&P itself traded 64%.
And semiconductors fell 2.28% on 50% of normal volume. That is the one we would flag. A 2% decline on half the usual volume is not heavy selling.
It is an absence of buyers, which is a different condition and arguably a more fragile one. Nobody had to sell hard to move that group today.
Now, the part we think is the most important thing that happened this week. Let's start with what is confirmed, because the headlines are easy to misread.
Demis Hassabis was chief executive of Google DeepMind. He is now chair of Google DeepMind and chief scientist of Alphabet, and he continues to run Isomorphic Labs. Koray Kavukcuoglu was DeepMind's chief technology officer. He is now a senior vice president running Google DeepMind day-to-day, Gemini model development, frontier research, and the Gemini developer apps, reporting directly to Sundar Pichai.
So the operational job changed hands. Kavukcuoglu runs it now. Hassabis moved to a mandate that is broader than DeepMind, but no longer operational. We're being precise about that because it is easy to read the coverage as saying Hassabis is still in charge.
Then the departures, and they are best understood by where people went. To a new company called Discovery Loop, Jeff Dean, Google's chief scientist of 27 years, Sanjay Ghemawat, Quoc, who co-founded Google Brain, and Oriol Vinyals, who led Gemini. To Anthropic, John Jumper, the Nobel laureate behind AlphaFold, plus Jonas Adler and Alexander Pritzel. To OpenAI, Noam Shazir, one of the authors of the Transformer paper.
Vinyals is the one with near-term operational consequences. He led Gemini, and he left in the same week the organization was restructured around shipping Gemini faster.
One more item, and we are flagging it carefully. There's a reported account that Hassabis intended to leave Google entirely and was persuaded to stay once Dean's exit landed. We could only find that in secondary coverage, not a primary source, and there is a competing report that he had been handing operational duties to Kavukcuoglu for more than a year, which would make this a planned succession rather than a retention. Those cannot both be true. Treated as reported, not confirmed.
So what connects all of this? Our read is that Google changed the order in which it does things.
The historical order at Google was research, then breakthrough, then product, then money. The order it is moving to is market, then product, then distribution, then model, then money. Those sound similar, and they produce completely different companies.
The forcing logic is that Google cannot maximize everything at once. Being the world's best fundamental research lab, shipping faster than OpenAI and Anthropic, protecting search economics, growing cloud, integrating AI across Android and Chrome and Workspace, and satisfying regulators. Something has to give. Our read is that what gave was research first.
And Sanjay Ghemawat's own stated reason on leaving points the same way. He said Google's infrastructure was built for search, ads, and large consumer applications, not for the iterative loops that frontier research needs. That is a verdict on the platform from one of the people who built it.
We should also say the pivot appears to be working commercially. At Google's developer conference this year, AI Mode passed 1 billion monthly users. AI Overviews reached roughly 2.5 billion. Gemini 3.5 Flash became the global default model for AI Mode. Gemini 4 is confirmed in training, and an 8th generation of TPU was announced.
That is not a company losing the AI race. That is a company that decided distribution matters more than being first, which is a choice, not a defeat.
One correction to a story we have seen circulating, including in our own earlier thinking. Discovery Loop was not created by Google as a release valve. It raised independently. The round was co-led by Radical Ventures and Khosla Ventures, with Alphabet participating as a minority investor on undisclosed terms. 4 people left, raised outside money, and Alphabet bought a slice afterwards. That is a weaker position than sponsoring a spin-out, which raises the question we think actually matters for the business. Does Google have to have the best model in the world?
Our answer is no, but with a threshold, and the threshold is the whole argument. If the ranking settles with someone else first, and Google's model is 95 to 98% as capable, Google is fine, because it owns Search, Chrome, Android, YouTube, Maps, Gmail, Workspace, Cloud, and its own silicon. Competitors own the model and rent the distribution. Google owns both.
But if that gap widens to something like 85%, the argument breaks. The model determines the quality of search answers, agents, coding tools, workspace features, ad optimization, and cloud services. At some distance, the model stops being a component and becomes the platform.
And if the best model belongs to somebody else, Google ends up in the position of a handset maker dependent on another company's operating system. That is the outcome Alphabet cannot accept. And in our view, it explains the urgency behind the reorganization better than any personality story does.
It also reframes the strategy. If you take that seriously, Google's goal may not be to beat OpenAI at frontier models. It may be to make good enough models cheap and ubiquitous so that nobody can hold the ecosystem hostage. Cheap, fast, everywhere, which is exactly what putting Flash in as the global default looks like.
Under that reading, the split makes sense rather than looking like a demotion. Hassabis owns what Alphabet's AI should become over 10 years. Kavukcuoglu owns shipping Gemini 4, 5, and 6 to 1 billion users. One person doing both was the previous arrangement, and the previous arrangement was slower.
We will say plainly that this is our interpretation and not a market consensus. The thing that would test it is release cadence from here. Gemini 4 is in training, and Pichai has talked about a near-monthly rhythm. Measure that against what actually ships. Let's widen it out, because Google is one of 5 companies that matter enormously here for a reason that has nothing to do with models.
They are the balance sheet behind the AI build-out. Microsoft alone is guiding to roughly $190 billion of calendar 2026 capital expenditure. In a detail from its last quarter that we keep coming back to, about $25 billion of that is attributed to higher component prices. Memory and storage specifically, which buys no additional capacity at all.
That is the same memory shortage we spent a whole education episode on, showing up as a line item in the largest software company in the world.
Microsoft also disclosed that its cloud revenue was $214 billion for the fiscal year, with nearly 90% coming from customers outside the frontier model companies. So the demand is broad, not just the labs buying from each other.
Which brings us to the part we want to be careful about. Our view is that Microsoft, Google, Amazon, Apple, and Meta are all long-term candidates for a portfolio. That is a statement about the businesses. It is not a statement about today's prices, and those are 2 different questions.
So here's the price question. Measured the only way we think is fair, each company against its own history, not against each other. Taking the forward multiple the market is charging today and ranking it inside that same company's own past range. Meta sits at the very bottom of its own range. Amazon near the 7th percentile. Microsoft near the 8th.
Alphabet sits at about the 77th percentile of its own history. Apple at about the 93rd.
So 4 of the 5 are being asked to carry a multiple that is cheap or ordinary by their own standards, and Alphabet and Apple are not. And the timing is what makes it a story for today rather than a lecture. Alphabet carries its richest relative multiple in years in the same week its Gemini lead. Its chief scientist and a brain co-founder all left.
That is not a prediction, and it is certainly not advice. It is an observation that a good company and a good entry price are separate questions. And right now, those 5 companies give 5 different answers. Our view, and not necessarily anyone else's.
Worth noting, too, that the mega caps were mostly green today, while semis fell 3%. Microsoft up 1.2%, Amazon up 1.3%. Alphabet up 0.7, Meta up 0.5, Apple down 1.6. Another rotation the flat index concealed.
Back to the tape and the day's biggest move. Crude reversed most of last week's decline. WTI up 5.14%, Brent up 5.05%.
The reported cause is that talks between the United States and Iran over reopening the Strait of Hormuz have stalled. President Trump said the United States is, in his words, only semi-negotiating and would rely on the naval blockade rather than further airstrikes. Iran's position is that it will not reopen without the blockade lifted and reparations paid.
For scale, the strait normally carries about 1/5 of the world's traded oil, and traffic through it is currently a fraction of normal.
And the usual shock absorber is thin. The U.S. Strategic Petroleum Reserve is at multi-decade lows, so there's less room to lean against the supply disruption than there would normally be.
Now, the part of today we found genuinely interesting because at first glance, it looks like a contradiction. Crude rose 5% and every crude tanker stock fell.
Frontline down 3.25%. Nordic American down 2.79%. DHT down 2.29%. International Seaways down 2.18%. TK Tankers down 1.35%. And Scorpio Tankers, which carries refined products rather than crude, a different trade, was up 0.47%.
That is the whole sector moving one way and the one name in a different business moving the other. So it is a mechanism, not company news.
And the mechanism is one sentence. A tanker company does not sell oil. It sells voyages.
With the strait effectively closed, tonnage is trapped inside the Gulf, idled, or sitting as floating storage, unable to trade. Gulf export volumes are suppressed as Asian buyers cut liftings. Spot rates did spike. Very large crude carrier day rates were reported around $425,000 at the peak. But a very high rate on a voyage you cannot execute is not revenue.
Equities price forward earnings, and forward earnings run through utilization. How many ships are actually working? With tonnage stuck, estimates get cut even while the headline rate is screaming. That is the entire disconnect.
The clean way to hold it is 3 states. Disrupted but still flowing. Longer routes, same volume, more ton miles is the good state for these companies. Stopped, which is where we are, is the bad one. Fully normalized is somewhere in between. These businesses want disruption, but not too much of it.
And one thing we specifically will not claim. We looked for evidence that today's tanker weakness reflected a view about political timing, that the market does not expect escalation before the midterms. We could not verify it in today's coverage, and the tape argues against it, because a political timing story would produce a mixed sector response, not a clean sweep. So we are leaving it out.
Which sets up Wednesday. July CPI is released Wednesday morning, and July CPI cannot contain August crude.
A benign July print describes a world in which oil was around $78. It is $82 now.
So it is possible to get a number the market likes on Wednesday, and a commodity it does not, in the same week. Those are not contradictory. They are just measuring different months.
Worth holding in mind before reading too much into whatever Wednesday prints.
Here is something we have not seen covered elsewhere, and we think it is the most useful thing in today's data. If you take average relative strength by sector across large caps, the dispersion is extreme.
Utilities. 41 large cap names. Average RSI 38.2, with 15 of them below 35, which is oversold by the conventional reading. Real estate. 44 names. Average 45.1, 5 below 35.
Technology. 154 large cap names. Average RSI 57.4. And not a single one below 35.
So 15 of 41 large cap utilities are technically oversold, and 0 of 154 large cap technology names are. That is not a small difference in degree. Those are 2 different markets happening at the same time.
And it is the honest version of the sentence, the market is fine. The index is flat because a bond proxy liquidation and an energy rally canceled each other out. Averages conceal, and this is what today's average was concealing. The explanation runs through the long end of the bond market. The 10-year is at 4.7%.
Utilities and real estate compete with bonds for the same income buyer. When long yields rise, that buyer has a better alternative, and the bond proxies get sold. It is not a judgment about the businesses.
And the volume tells you it is real. Utilities fell on 118% of average volume, one of only 2 sectors with genuine participation today. That is people actually selling, not the drift we saw everywhere else.
Which means it is likely to continue until long yields stabilize. That is where the stress is currently showing up, and we would rather name it than pretend the flat index is the whole picture.
Optical networking had a bad day, and it had a very specific shape. Every name in the group opened higher and closed lower.
Coherent closed at $325.15, down 14.2% on the day and just under 16% from its high. Lumentum closed at $813.51, down 8.6%. Fabrinet at $527.07, down 6.3%. Applied Optoelectronics closed at $132.81, down 2.1%, but almost 11% below where it traded at the high.
And Applied Optoelectronics is the one worth dwelling on because it reported record results. Revenue up 86% to $191.9 million. Adjusted earnings of 6 cents against 2 cents expected. Third quarter guided to between $255 and $290 million. A new hyperscale customer and capacity sold out through the middle of 2027.
It traded up almost 10% at the high and finished the day red. Our read is that what came out of these names was the policy premium from last week's report that the FCC is drafting a ban on Chinese optical transceivers, and we would stress the word draft. There is no publication date and no effective date. It is not a rule.
The control group supports that reading. Arista was up 1.5% and Broadcom down 1.25%. If this had been a scare about AI demand, they would have been down with the group. It was specific to optics.
And the reason we think the trade is genuinely two-sided. Chinese suppliers are roughly 2/3 of data center transceivers, and replacing them is estimated at 12 to 24 months. So a ban would create shortage and pricing power rather than an immediate transfer of share. Meanwhile, China refines about 70% of the world's indium and has had indium phosphide under export licensing since February 2025, with wafer prices reportedly up around 250%. Western module makers need Chinese indium phosphide to build the lasers that would replace Chinese modules.
Intel closed at $97.52, down 4.06%, after announcing a $15 billion common stock offering plus a $2.25 billion green shoe. That is roughly 150 million shares, or 3 to 3.5% dilution.
And the stock fell almost exactly the dilution. The market priced arithmetic, not distress.
Which, we would argue, is the rational response. The raise funds capital expenditure into demand that currently exceeds capacity, and choosing equity over debt preserves the investment-grade rating with the 10-year at 4.7%.
It is also a generally useful way to read any equity offering. Compare the fall to the dilution. A company raising money to plug a hole gets marked down far more than its share count. A company raising to build tends to get marked down by roughly the arithmetic. The gap between the two is the market's verdict on what the money is for.
So to the week. Tuesday after the close, CoreWeave and Lumentum. Wednesday at 8:30 Eastern, July CPI. Wednesday after the close, Coherent, Cisco, and Cerebras. Thursday morning, July PPI, and Thursday after the close, Applied Materials.
Consensus for July? CPI is headline up 0.1% on the month, core up 0.3%, headline around 3.4 to 3.5% year-on-year, and core around 2.5. The Cleveland Fed's nowcast has headline at 0.09 and core at 0.21.
So the entire disagreement is 0.1 of a percentage point on core inflation. That is the distance between the Fed being able to relax and September being live.
And the disagreement worth ending on. Fed funds futures price roughly a 46% chance of a September hike, down from about 67% a week ago. Morgan Stanley's published house view is no hike at all in 2026, with cuts in March and June of 2027. Those cannot both be right, and Wednesday is the referee.
A market at a record on the lightest volume in weeks, waiting on 0.1%. That is where we leave it. That's a wrap. If this was useful, follow or subscribe for the next one, and tell us where we're wrong. Thanks for listening.